Hey, welcome to the Growth View Capital Search Fund Introduction to Small Business Buyouts and Growth Equity webinar. And today we're going to be talking about what we're doing specifically in the world of search and private equity as it relates to buying companies in the lower middle market. We're going to introduce you to the team. We're going to introduce you to the opportunity. We're going to talk more specifically about the types of businesses that we like to buy, as well as some of the risks that come along with it, as well as some of the advantages that come along with it. And then from there, we'll talk next steps as to how you guys can get in touch with us if you wanted to move forward and talk a little bit more about what it would mean to become an investor in this year's 2023 Growth Fund. But before we jump in, my name is Samson Jagoras. I've spent the last 15 years in entrepreneurship, business development, finance, everything from being a commodities broker and a trader to scaling up a large marketing and technology company to well over 100 million in top line revenue. For the last 4 years of my career, I've been focused on private equity, everything from real estate private equity, development, acquisition, and buying businesses, consulting businesses. I own several companies, and these are my partners. In the middle there, you'll see Jeremy Cisneros, who comes from the world of McDonald's franchising, comes from the world of commercial underwriting for real estate, is an entrepreneur and a real estate and underwriting professional. And then far right top is Brad Penley. Brad Penley handles capital development. He's a lieutenant commander actually in the Navy and has spent a large majority of his career leading teams and people through war strategy, and now raises capital for the Growth View Capital Group. Bottom left, you're going to see Scott Shepard. Scott Shepard is one of our newest partners and principals. He manages a $60 million cattle fund. He is a cattle trader. He spent a long time in the world of commodities trading. He plays a role in our company as a compliance expert, knows a lot about the world of the SEC, and he's also just a serial finance and investment expert. In the middle, Justin North. Justin North is an attorney at Gessler Blue. He's one of the principal partners here. He handles all contract law, as well as compliance law, as well as SEC law, to just make sure that all of our fund documentation, our contracts, our acquisitions are buttoned up. And then bottom right, Bobby Shell comes from the world of marketing and technology, actually owns his own marketing agency, and he handles investor relations to make sure that all the beautiful content that you guys see coming from us as it relates to all the investments that you're involved in are swell and top notch. And as you can see, we actually have a built-in advisory board, right? From CEOs to CFOs to entrepreneurs to legal to marketing, all the attributes that our entrepreneurs who are within the search fund are ultimately going to need. So we offer, just as a team, a lot of expertise to fill in some of the gaps. And we think that that's one of our competitive advantages as an entrepreneurial principal managing group of this fund, to be able to help our entrepreneurs in a way that an individual fund manager never could, because they do not have the experience or acumen, let alone can they have the experience across all the 8 core concepts of business, which would be leadership, finance, operations, growth, product, service, sales, and marketing. We're at the starting line of the greatest wealth transfer in history, as $96 trillion of wealth will transfer from the baby boomer generation to the next generation. And we know that $7 trillion of that is going to come in the form of business. We spent a lot of time in the world of multifamily. We've underwritten thousands of deals, and we own multifamily. But we see a convergence on the real estate market where the return profile is getting smaller and smaller. Everybody's competing for the same deals. Institutional money has stepped in, and so it's made it incredibly challenging to find really good returns for investors. So where do you go when the returns get tight? You look for the next best opportunity, and we believe that's in privately held businesses that are going to transfer from the boomer generation to the next generation. Why? Because the baby boomer owners are tired, and they don't want to continue running their businesses, having 50, 60 employees and being responsible for call it $20 million in top line revenue can get exhausting, where they're likely going to keep their real estate. They probably won't keep their business. And crazy enough, 58% of baby boomers do not have a legacy or transition plan. So we're looking for these companies that have had longstanding owner operators who are baby boomers who are looking to retire, and we can step into cash flow and we can add value to these businesses by way of the 8 core concepts that I already alluded to, which are leadership, finance, operations, growth, product, service, sales, and marketing. A lot of these businesses have been run the same way for a very long time, and it makes them very, very effective. But they could be more effective by bringing in more modern practices, more technology, more salespeople, so on and so forth. But they're also heavy cash flow, and so that allows us to upgrade and innovate the business at a fraction of the cost of starting up. Your biggest problem when you're starting up a business is you don't have income, and so reinvesting back into the business can be incredibly challenging. But if you're talking about a business that's doing, call it $22 million a year in top line revenue, often the owner is writing himself a check for $3 to $4 million a year. So by being able to put a CEO in place, paying them a healthy salary, still having a ton of cash to be able to reinvest back into the business for more innovation, still being able to pay our debts, still being able to pay our investors, we see that as a very, very competitive advantage, something that you can't really get in the world of real estate. So as I've already alluded to, why business? Well, there's less competition than there is in real estate because it's harder. It's harder to own passively, especially in the lower middle market. We're not competing with institutional capital groups and pure financial buyers like we would be, say, in multifamily. We have an unmatched competitive advantage by the way of our managing principals and our operating pros, which I've already alluded to, the experience and tenure and the advisory board that's built in by way of the managing principals. We'll dive into our operating pros here in a little bit. And then we're just bringing corporate level acumen, leadership, board structure to a lower middle, small business, which is something that generally doesn't exist, right? The blue collar, hardworking entrepreneur who grew a 10, 20, $30 million a year top line revenue business, just did it by sweat equity over 30 or 40 years. They didn't have some, big capital raise on the front end. And so some of the sophistication that comes into those businesses is actually surprisingly not that high. And then obviously businesses have strong cash flow. We still get the tax benefit. We have greater control over our income by way of sales, marketing, and technology to create more scale, which is something we definitely do not have in the world of real estate. We have a very kind of fixed growth schedule for our real estate and marketing. You can change your prices, or excuse me, in business, you can change your prices, you can increase your marketing, you can spend more marketing dollars, you can facilitate new partnerships to generate new leads and do things that you just would never be able to do in real estate. So we love that about business as well. Now, for us specifically, we're really focused on the trades. We like the trades because we believe that they're recession resilient, not necessarily recession proof, but recession resilient. So, it doesn't matter how much money Elon Musk makes. If his heater goes out, he's going to call an HVAC guy or an HVAC company. It doesn't matter, what's going on in the economy. If your toilet floods and you need to have somebody come clean your sewage pipe, you're going to call a plumber. Doesn't matter if the economy is going up, down, or sideways. Everybody's still making trash. So junk and waste is still viable. Now, between those lines, obviously getting an understanding of how the revenue is spread out across the different sectors of that they serve. So is it, concentrated in commercial versus residential? Are they doing a lot of construction work, right? All those things matter in building a more balanced portfolio. And those are things that we would know up front during our due diligence. But in general, the barrier of entry to get into these businesses is generally pretty hard because they have a very heavy startup cost. Like if you wanted to go start a trash company tomorrow, you got to spend $250,000 on trash trucks and, a couple $100,000 on roll-off dumpsters. And it's just not so easy for somebody to just jump into and scale up straight away. And so the ability to step in and buy those businesses that have really strong contracts, already have assets in place that are already creating income is very, very attractive. And then obviously the greater the upfront CapEx it is to start that business, the higher the margins, right? So, talk about concrete, trash, restoration, all of those businesses have margins anywhere from 30 to sometimes 60% if there's insurance involved. And then focusing on the trades allows us another efficiency, which is the capacity for a roll-up or a hub and spoke model, right? So buying a contracting company, being able to roll in an electrical contracting company, an HVAC company, a plumbing company, and be able to kind of grease your own hand across all the different businesses that you own in a given region or a given state or market. And then obviously just immense opportunity nationally. Again, it doesn't really matter what's happening in the local economy. People are still making trash. They still have HVAC problems. They still have electrical problems. So there's still an immense amount of opportunity to just be a better operator and take a long-standing company and improve it by way of more operational efficiency. Okay, so you've heard me allude a little bit to the lower middle market, right? So we like businesses that are at least doing over $1 million a year in top line revenue. That doesn't include any pass through like material costs. We're talking about businesses that are actually earning $1 million a year for the services that they're delivering, all the way up to potentially $30 million in revenue. That's kind of the sweet spot because it's an odd part of the market where larger companies won't really buy them. Big enough that an owner operator might have a more difficult time to buy that, and a great place for strategic search funds and private equity groups like ours to buy, place in operators, and potentially do strategic mergers. And we're not competing against institutional guys and investment banks, so on and so forth, that would generally be competing at the higher level, call it 50, 100, $250 million of equity. These businesses, we think, also have the most operational upside. To go from $1 million to 10 million in the electrical contracting space is a really incredible feat. To go from 10 million to 20 million, even more incredible. To go from 20 million to 40 million requires some different thinking in and around the business model and a more strategic thought put towards how you would engineer an exit in the future. So we think that they have the most exit optionality to sell, cash flow, recap the business, license, franchise, or roll up other businesses compared to the upper part of the upper middle market. We also believe that we have a competitive advantage over other funds in that we have this very, very deep network of existing operators, so people who already own and operate businesses. And that comes from just our deep entrepreneurial background, having been in the game for a very long time. In my former life, we had 20,000 small business accounts across the entire nation. So me personally, I have a deep network of entrepreneurs that we work with. But we also have this deep network in the Naval Academy graduates. So two of the principals, Justin North and Brad Penley, are both Naval Academy grads. Justin North graduated, served for approximately 9 years, then went back to school at Notre Dame Law. And there are a ton of great Naval Academy grads who took a similar route. They graduated from the Naval Academy, they went and served, they then went to the top 5 B schools in the country, then went on to go work in consulting at the highest level. And we're talking about BCG, McKinsey, PwC. And so they've developed an immense amount of experience, but they also have this unique quality, this leadership quality to lead blue collar type of people, right? Which was the type of people that they led in the military. They have this business acumen and experience. They have this incredible leadership quality. And then they're backed up by principals who have entrepreneurial experience and can kind of fill in the gaps as their advisory board. So between working with operators who already have existing businesses that are doing really well, who want to roll up and acquire more companies to get more expansion across, say, a market, we also have search fund operating pros who are out there regularly looking and sourcing opportunities in their respective markets in order to be able to buy, own, and operate a company. And regardless of whether they're an operating pro who is just searching for the first time or an existing business owner, we create buy-in and a level of cohesiveness between the two organizations by getting those CEOs to co-invest alongside of us in order to create a stickiness between their company and the success of that company and ours. But what's the risk with that, right? So the risk is some of these searchers, as I just alluded to, this might be the first time that they're going to operate a business. So though they have, immense leadership skill, graduated from the Naval Academy, went to Wharton, for example, worked at BCG or McKinsey, and have come across a lot of things, there's going to be some bumps along the way that they have just never experienced. And, quite frankly, a lot of people watching this webinar have probably never experienced if they're not entrepreneurs, because you wouldn't know them or experience them unless you're in the game. And that's the advantage of having a built-in board of entrepreneurial principals and advisors like the Growth View Capital team. It's also the advantage of just buying strong cash flowing businesses. To be frank, there's going to be errors. So being able to have more wiggle room and not have essentially a gun to our head to make decisions based off of a limited amount of cash flow is a great place to be. And honestly, in an absolute worst case scenario, should something happen to one of those operators, we have an equipped board of advisors and a deep network of operating pros that could either step in and operate as the CEO, or we could find another operator to step in. That said, it's business, right? So the reason that you see higher yields in business than you do in real estate, because there's more risk. But we can remove some of that by buying established businesses with strong cash flows in markets that we like, with great operators who have experience backed up by our managing principals who can step in and advise in order to take the business to the next level. And then the secret sauce, which comes directly from my M&A brokerage firm. So I own an M&A brokerage firm called Clearly Acquired. You can go to clearlyacquired.com, and we specifically work with clients to buy and sell businesses on our platform. And we have a full protocol for how we can actually vet businesses out on the front end in order to remove as much risk as possible before we even close on the transaction. And so this is a little example of our process here. I won't walk through this whole thing, but you can see with great detail and depth, we support every searcher through the process of acquiring the business in order to make sure that we know what our risk is prior to getting into the deal. Okay, so let's talk about what a search fund is. So essentially, a search fund is just an investment vehicle. It's no different than any other fund, but the idea was kind of conceived in 1984, where searchers, people who are going to look to buy businesses, would stand up a fund and they would effectively raise money, and they would go hunt to find a business that they would then buy. That has then evolved into a model more like what we're talking about today, where you have a principal group of fund managers who are overseeing the fund and partnering with searchers, operating pros, in order to go and buy companies. And typically a search fund can support anywhere from, let's call it, 6 to 12 searchers, depending on the size of that, right? So a $5 million fund would support about 6 searchers. A $10 million fund could support about 12 searchers. And typically you'd find about 8 businesses that you could invest in within that fund. Search fund companies are small compared to traditional private equity. At a max, you probably see them get up to 10 or 25 million when the fund is bought. But compare that to the average private equity buyout of 2.5 billion. That's a really wide swath of funds that we're not really competing with, right? And it's just a slightly different structure targeting a slightly different part of the market, which we believe is incredibly inefficient. And that's what gives us the most competitive advantage, because we have more opportunities to speak directly with owner operators than we ever would, say, like in something like large commercial multifamily, where all of those deals go out to a public, fully marketed campaign. Okay, let's talk about returns. So, traditionally search funds show better returns than traditional private equity by generating IRR somewhere in the 20 to 25% versus 12%. And again, that comes down to the sheer velocity and opportunity for upside in those businesses, because they're smaller, slightly more inefficient, and less sophisticated. We have a lot more leverage to pull more levers with great cash flow to push the business forward and increase the velocity money at a rate that is much harder to do in a $100 million, $250 million company. The other thing we like about the search fund model is, typically we see about 32.1% annually return before fees in that model, which is, significantly higher than the traditional private equity model of 12%. And then obviously just the underlying companies are just way more compelling to own, right? A typical search fund owns businesses in a small but fast growing market or sector, with a player who has really high potential and a really strong management team. So most of the value creation comes from gaining market share, improving the business's core operations, which is where we feel like we have the most skill set, just given our background in entrepreneurship and scaling up companies. The timeline for a typical fund looks like this. So as we prepare to launch our fund, it'll typically take anywhere from 2 to 5 months to raise the money. We'll spend the next 6 to 24 months with our searchers tracking down businesses to buy. It'll take about 2 to 5 months to present and close on the businesses that we want. And then we'll operate the fund for 3 to 8 years with a plan to sell in the back half of that 8 to 10 years to sell those businesses, recap the business. That said, obviously, if we're hitting our return projections and return profiles, we're not afraid to recap the business, sell, or acquire more businesses. But we ultimately have that decision made prior to even buying the business before we were to ever exit. So just to wrap it all up, we're at the starting line of the greatest wealth transfer in history. $96 trillion of wealth is going to transfer from the baby boomer generation to the next generation. 7 trillion of that will be in the form of business. And there's 10,000 baby boomers retiring every single day. By 2030, all baby boomers will be over the age of 65. 58% of those boomer owners do not have a legacy or transition plan. So there's a massive gap in just buyers for those businesses. And if we don't buy them, then they're going to close shop or they're going to go to somebody else. There's also just a massive gap in the trades worker coming to the market. So a competitive advantage to buying these established businesses that have 30, 40, 50, blue collar trade workers with very high skill is there's no shortage of business. For example, here in Colorado, there's not enough electrical contractors. And most of these electrical contracting businesses are having to turn away business because there's just too much work, especially as we continue to electrify the grid. Privately held, mature, service-based, cash-flowing businesses that are recession resilient is our focus, and specifically those that have value-add potential by way of leadership, finance, operations, growth, product, service, sales, and marketing. We're also looking for businesses that are heavy cash flowing, that allow us to upgrade, innovate the business at a fraction of the cost of starting up. And we're working with proven, leaders and operators who are, operating pros who already are doing it in a specific sector where we want to be, or they're Naval Academy grads who led at the highest level in the military, who went on to the top 5 B schools, who now work in consulting at like McKinsey, Deloitte, so on and so forth. So if you guys want to learn more, you can just fill out the form below, and either Brad Penley or myself, Samson Jagoras, we will reach out to talk about next steps, how you can get involved as an investor in the upcoming search fund. And we look forward to meeting you.